Well, folks often ask me after all these years, what's the biggest lesson I've learned or what mistake stands out the most? The truth is, there have been plenty of missteps along the way, more than a few real bonehead moves that I could tell you about. But there's one that always comes to mind, a mistake that cost us billions in opportunity cost. And it's right there in the name of our company, Berkshire Hathaway. Back in the early 1960s, I started buying shares in Berkshire Hathaway, which at the time was a struggling textile mill up in New England. I had met the chairman, Seabury Stanton, and thought I had a handle on the situation. The stock was cheap, selling below its working capital, and I figured there was an arbitrage play. We'd buy it, maybe do a tender, and make a quick buck. I more and more eventually gaining control of the company. I was looking at the balance sheet, the assets, the price, thinking I was a smart operator, a real Ben Graham disciple, buying a cigar butt with a few puffs left. But here's the deal. I was dumb enough to think I could turn a dying business around. The textile industry in New England was in a death spiral, facing cheaper labor overseas, technological obsolescence, and just brutal competition. Every year we'd put more money into it, hoping for a turnaround, buying new machinery, trying to compete. It was like throwing good money after bad, pouring capital into a bottomless pit. I was in love with the cheapness of the stock, not the economics of the business itself. It was a classic trap, and I walked right into it with my eyes wide open, stubborn as a mule. My partner, Charlie Munger, he started seeing it clearly before I did, though it took him a while to knock some sense into me. He'd patiently point out, Warren, we're in a terrible business, consuming capital, and for what? To earn a lousy return on capital in a truly miserable industry. He kept saying we needed to get out of businesses that didn't make economic sense, no matter how cheap the stock might seem initially. What a simple, obvious truth, but it took me years and a lot of wasted capital to fully grasp it. The value of that initial investment in Berkshire, if it had been put into a truly wonderful business, would be hundreds of billions more today. It was a $200 billion mistake in opportunity cost by my estimation. Here's what I learned from that long, painful experience with Berkshire's textile operations. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Ben Graham taught me the margin of safety, and that's critical. You need to buy things for less than they're worth. But Graham, bless his heart, sometimes put too much emphasis on the quantitative, on asset values and balance sheets, and not enough on the qualitative aspects of a business, on its inherent economic power and future prospects. That's where Phil Fisher came in, and later Charlie Munger really drove the point home. You see, investing isn't like picking up discarded cigar butts that have one last puff left. That might work for a while, but it's a grind, and you're always looking for the next discard. True wealth is built by owning a piece of a truly wonderful business, a business that has something special, something that allows it to earn high returns on capital consistently over a long period. We call that a moat, a sustainable competitive advantage that protects it from rivals, like a castle surrounded by a wide, deep moat. If you don't understand the moat, you don't understand the business. Think about this. If you're buying a farm, you're not just looking at the price per acre. You're looking at the fertility of the soil, the rainfall, the access to markets, the management of the farmer, the crops it can consistently produce year after year. A cheap price for barren land isn't a bargain, it's a waste of capital. A fair price for fertile land with a good manager and consistent harvest is a wonderful investment. It's really quite simple, and you don't need fancy math to figure it out. Just common sense about how businesses actually operate and make money. This lesson, hard won through the textile mills, directly led us to our approach with companies like See's Candies. We bought See's in 1972 for about $25 million. At the time, it was doing about $30 million in sales and making $4 million pre-tax. Now, that might not sound like a bargain in terms of earnings multiple, But Charlie and I recognized something special. See's had incredible brand loyalty, a simple product, and pricing power. It was beloved in California, and people would pay a premium for their chocolates, especially around holidays. It had a wide moat, a strong consumer franchise, and very modest capital requirements. My dad taught me the value of a good brand, and See's was a perfect example. We didn't have to put much capital back into the business to grow it. It threw off cash year after year, cash that we could then use to buy other businesses. See's, a seemingly simple candy company, has since earned Berkshire over $2 billion in pre-tax profits, all from that initial $25 million investment, and it continues to be a cash cow. That's the power of owning a wonderful business that you understand, with a wide moat, excellent management, and the ability to raise prices. It wasn't about buying something cheap on the balance sheet. It was about buying something valuable in the hearts and minds of its customers. Another great example is Coca-Cola. We started buying shares in 1988, eventually investing about a $1.3 billion. People thought it was a mature company, but we saw a global brand with incredible reach, a product ingrained in daily life, and simple economics. It costs pennies to make and sells for dollars. That's a powerful combination. It wasn't about the next big invention. It was about the consistent, predictable earnings stream from a product people loved worldwide. We understood that business. We could project its future earnings with reasonable confidence, which is key. When we first bought Coke, the stock was trading at a reasonable multiple, but certainly not a cigar butt valuation. It was a wonderful company at a fair price. Our initial investment has grown into something like $25 billion, and we get an incredible dividend stream every year that more than covers our original cost. That's the compounding magic of owning a quality business for the long term. Our favorite holding period is forever, provided the business continues to perform and its moat remains intact. So if you're a young investor today, the first thing I'd tell my younger self, having learned from the textile mills and celebrated with See's and Coke, is to really understand what you own. Never invest in a business you can't understand. If you can't explain what the company does, how it makes money, and why it has a competitive advantage, then you shouldn't be buying its stock. That's not about IQ. I've seen people with 60 IQs fail spectacularly in investing because they get caught up in complexity or try to predict short-term market movements. It's about clarity of thought and sticking to what's within your circle of competence. My circle of competence isn't very large. Well, I don't invest in complicated tech companies for the most part because I don't understand them. I couldn't tell you how a lot of these cutting edge businesses will look in 10 or 20. That's why Apple was an unusual step for us. But even with Apple, it was less about the technology and more about the consumer ecosystem and the incredible brand loyalty. It functions like a consumer products company, and that we could understand. You don't need to do extraordinary things to get extraordinary results. You just need to consistently do ordinary things extraordinarily well, like sticking to what you know. People think you need to be constantly active, following every news report, checking stock prices hourly. But actually, the opposite is true. Most of my day is spent reading. I read 5 to 6 hours a day, probably 500 pages or more. Annual reports, 10Ks, industry journals, newspapers, books. That's how I expand my knowledge. And more importantly, how I refine my understanding of the businesses I already own or am considering. It's a quiet, patient process, and it allows me to think without the noise of the market. This applies to any business, not just investing. Whether you're running a small shop in Omaha or a multinational corporation, what really matters in business is finding something that provides lasting value to customers, building a sustainable advantage, and having managers who are both competent and honest. We want businesses that we understand, that have good economics and are run by people we trust. It sounds simple, but it's astonishing how many people overlook these basic tenets. They get distracted by fads, by exciting stories, by things that are fashionable but lack fundamental value. Quality of management is paramount too. Charlie always tells me when a management team with a reputation for billions tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. We saw that with the textile business, and I've seen it many times since. You can have the smartest people in the world, but if they're working in a fundamentally bad business, they're going to struggle. Conversely, average managers in a wonderful business can produce outstanding results. But that's not the only lesson I learned the hard way. Understanding the business is critical, but so is understanding human nature, especially your own. This reminds me of another time when my temperament got the better of me, a time when fear and herd mentality almost cost us a fortune, and how Charlie and I sat in the office watching it unfold. The next mistake, or rather the next major test of our conviction, involved American Express, and it taught me a whole lot about Mr. Market and the psychology of crowds. Back in 1964, a scandal erupted involving a subsidiary of American Express called Allied Crude Vegetable Oil. This fellow, Tino DeAngelis, was essentially defrauding everyone using water-filled tanks to collateralize millions in loans, claiming they were full of salad oil. When the whole thing collapsed, it looked like American Express, through its warehouse receipts, on the hook for hundreds of millions of dollars, a sum that could have wiped out the company. The stock plunged from $60 to $35 in a matter of days. Panic set in on Wall Street. Everyone was dumping American Express stock. The newspapers were full of doom and gloom. People were convinced the company was going under. But Charlie and I, we just kept our heads down. I remember flying to New York and spending a week going around visiting American Express offices, talking to employees, even visiting the warehouses to see what was really going on. I ate lunch at their cafeteria, paid with an American Express card, and watched how people used their travelers' checks. I even asked the barbers and taxi drivers if they trusted American Express. What I found was that the salad oil mess, while a massive financial hit, hadn't damaged the core business, the brand, the credit card, the traveler's checks. People still trusted American Express. The franchise, the moat was intact. The underlying economics were still sound. The company was profitable in its core operations and could absorb the hit over time. The market, in its panic, was throwing the baby out with the bathwater. So what did we do? From 1964 to 1966, my partnership invested about $13 million into American Express, a huge chunk of our capital at the time. We bought it when others were terrified. That $13 million turned into over $20 million in just a few years, and we made a tidy profit. But more importantly, it reinforced a critical lesson taught to me by Ben Graham. The market is there to serve you, not instruct you. Imagine market showing up at your door every day, offering to buy your shares or sell you more. Some days he's ecstatic, offering you a high price. Other days he's depressed, offering to sell you shares for a song. Your job isn't to let his moods dictate your actions. It's to take advantage of them. When he's depressed and selling cheap, you buy. When he's euphoric and buying high, you consider selling. It's really that simple. This brings us to a timeless principle. Be fearful when others are greedy, and greedy when others are fearful. It sounds easy to say, but it's incredibly hard to do in practice. Human nature pushes us to conform, to follow the crowd. When everyone else is panicking, the urge to panic with them is immense. When everyone else is making money hand over fist in some hot new thing, the fear of missing out, or FOMO as they call it now, can be overwhelming. But successful investing requires an independent mind, a willingness to look foolish in the short term, and the discipline to stick to your own analysis of intrinsic value. At Berkshire, we've always tried to ignore the daily gyrations of the market. We don't care what the stock price does tomorrow or next week. We care about the underlying business performance over years and decades. When we bought Geico, for example, we saw a fundamentally sound business with a strong competitive advantage in its direct-to-consumer model. We bought a large stake in the early 1950s, sold some, then bought the whole thing in 1996 for two. Geico has become a powerhouse, growing steadily, delivering billions in profits. We never worried about whether the market liked insurance stocks that particular month. We focused on the value of the business itself. Another time, our temperament and understanding of intrinsic value served us well was during the American Express case, as I said, but also with the Washington Post Company. We started buying shares, and it was a well-run company with strong local monopolies in its newspaper and television stations. The market was valuing it like it was going out of business, but we knew better. Catherine Graham, the publisher, was an extraordinary leader. We got to know her and trusted her implicitly. We held that stock for decades, and it delivered incredible returns. It goes to show that if you understand the business and trust the people running it, you can weather any storm. So what's my practical wisdom for investors today regarding temperament? Develop an independent mind. Don't listen to the talking heads on television or the pundits predicting every market turn. They're selling advertising, not investment advice. Focus on finding truly wonderful businesses at sensible prices and then sit on them. Let time and compounding do their work. Compounding is the eighth wonder of the world. Truly, if you can let your investments grow year after year, patiently, without interference, the results can be astonishing. Just look at what a penny compounded at a reasonable rate for a century can become. You don't need fancy math or sophisticated algorithms to do this. What you need is a sound intellectual framework, patience, and emotional control. The greatest enemy of the average investor is not the stock market itself, but his reactions to it. The market is efficient in the long term, yes, but in the short term, it's a manic depressive friend named Mr. Market. Your job is to ignore his mood swings and just take advantage when he's feeling particularly generous or particularly desperate. This connects to a broader business principle, building for the long term. At Berkshire, we're not looking to flip companies. We're looking to own them forever. We want managers who think the same way, who aren't focused on quarterly earnings reports, but on building enduring value for shareholders over decades. When we buy a company, we want the existing management to stay, to keep doing what they do best without interference from us, provided they're good at it. We found that giving good people autonomy and aligning their interests with ours through equity ownership is a powerful recipe for success. Take Ajit Jain, he runs our insurance operations, for example. We gave him the ball decades ago, and he's built an incredible business for us, one that consistently underwrites profitably and generates massive float. He's a genius in his field, and we trust him completely. Same with Greg Abel, who oversees our non-insurance operations. We hire great people, give them the resources they need, and let them run their businesses. We don't meddle. That's how you build an enduring conglomerate, not by trying to micromanage everything from Omaha, Nebraska. But even with great businesses and great people, you can still make mistakes if you don't think carefully about competitive advantages. This reminds me of another misstep, one that involved not fully appreciating how quickly a moat could disappear. I'm talking about the department store industry, and specifically the case of Dexter Shoes, which was a real clunker for us, a painful reminder of what happens when you misjudge the staying power of a business. We bought Dexter Shoes in 1993 for $133 million, paying with Berkshire stock. Now, I thought Dexter had a decent brand, made good shoes, and had a strong distribution network. It was a New England company, and I liked the idea of a solid American manufacturer. I thought it had a durable competitive advantage. I was wrong. The footwear industry quickly globalized, cheaper labor overseas, combined with changes in retail distribution, meant that Dexter's moat rapidly evaporated. The brand no longer commanded a premium, and its manufacturing costs made it uncompetitive. It was a classic case of misjudging the business and its economic prospects. The stock we paid for Dexter, had we just held on to it, would have been worth billions more today. It was a massive opportunity cost, probably a couple of $1 billion by the time it was all said and done. What a bonehead move. I often joke that I've never put that mistake in the annual letter because I paid for it with stock, which makes it harder to quantify. But the truth is, it was a fundamental misjudgment on my part about the durability of that business model in a rapidly changing world. I was too focused on what it had been rather than what it would become. Here's a lesson from Dexter Shoes. Moats can erode. A competitive advantage isn't something you acquire once and keep forever. It needs to be constantly defended, constantly reinforced. And sometimes technological or economic changes can simply bypass your moat, rendering it obsolete. We want businesses that have wide, durable moats, ideally ones that are widening, not narrowing. And if we can't be sure about the durability, we stay away, no matter how attractive the initial price seems. This is why we love businesses that sell products or services that are essential, sticky, and have some form of pricing power. Think about utilities or certain consumer staples. Nobody wakes up thrilled to pay their electric bill, but they pay it because they need electricity. Think about credit card networks like Visa and MasterCard. They take a small slice of every transaction and they're deeply embedded in the financial system. That's a powerful moat. They're businesses that are simple to understand and whose future earnings streams are reasonably predictable. My dad taught me that a good reputation is worth more than money, and the same goes for a business. A brand is a powerful moat. See's Candies, Coca-Cola, even our insurance companies like Geico, these brands inspire trust and loyalty, which allows them to earn higher margins and retain customers. It's not just about a low price. It's about the perceived value and reliability that a strong brand conveys. Investing in a business with a weak or non-existent brand, especially in a competitive industry, is a recipe for mediocrity at best. For young investors, understanding moats means doing your homework. Don't just look at the current financials. Think about where the company will be in 5, 10, 20 years. What prevents competitors from simply replicating their success? Is it intellectual property, a unique distribution network, scale advantages, brand loyalty, switching costs for customers? These are the questions you need to answer. If you can't identify a durable moat, then you're probably just speculating, not investing. You don't need to predict the future with perfect accuracy. Nobody can do that. But you can identify businesses that are highly likely to remain dominant in their respective industries. You can understand the basic economics of the business and the industry it operates in. When I was running my partnership in the 1960s, I used to read hundreds of annual reports looking for these gems. I still do, spending 80% of my day reading and thinking it's the best investment of my time. This also applies to avoiding debt. I've never borrowed significant money to buy stocks. Leverage magnifies both gains and losses. If you're wrong, even a little bit, leverage can wipe you out. We run Berkshire with very little debt relative to our equity, and our balance sheet is rock solid because you never know when Mr. Market is going to throw a tantrum or when the economy will hit a rough patch. If you're over leveraged, you're forced to sell at the worst possible time. As Charlie says, the only way to get rich is to get rich slowly. Avoiding debt keeps you in the game, allowing compounding to work its magic over decades. But avoiding mistakes isn't just about understanding businesses and having the right temperament. Sometimes it's about having the humility to admit when you're wrong and cut your losses, even if it hurts your ego. This brings me to another hard lesson I learned, which involved a company overseas, a retailer named Tesco. And it taught me about the dangers of losing sight of a business's fundamentals and letting an investment drift. We started buying Tesco, the British supermarket chain, in 2000. We thought it was a solid business, a bit like the Walmart of the UK, with a good market position and decent returns. We built up a significant stake, around $2.3 billion. But then things started to go sideways. Management made some questionable decisions. Competition intensified, and their competitive position began to erode. I was slow to react. I kept hoping things would turn around. I held on to it too long, letting the situation deteriorate further. By the time we finally sold out completely in 2014, we had lost a significant amount of money, about 33 million pre-tax, not counting the opportunity cost of having that capital tied up elsewhere. What a fool I was. I had violated one of my own core principles. If the fundamentals of the business change for the worse and its mode is shrinking, you need to reevaluate and be prepared to exit even at a loss. I got stubborn and it cost us. The dumbest reason to buy a stock is because it's going up. Then the dumbest reason to hold on to one is because you've already bought it. I was wrong about Tesco. I made an investment mistake, pure and simple. I should have recognized the deteriorating fundamentals earlier, swallowed my pride, and sold. It's far better to sell a stock and realize a loss than to hold on to a shrinking business in the hope that it will miraculously recover, especially if that hope is unsupported by economic reality. Charlie always says, when you find yourself in a hole, stop digging. I kept digging with Tesco for too long. This lesson underscores the importance of continuous monitoring of your investments, not just their stock prices, but the actual underlying businesses. You need to keep asking yourself, is this business still as strong as it was when I bought it? Is its competitive position improving or deteriorating? Are the managers still allocating capital wisely? If the answers start turning negative, you need to be honest with yourself, no matter how much it pains your ego to admit a mistake. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, obviously, we've lost money on investments. That's inevitable in this business. But the spirit of that rule is about avoiding permanent loss of capital and avoiding situations where the odds are stacked against you. It's about being disciplined in your valuation and having a margin of safety. If you buy a business for significantly less than its intrinsic value, even if things go a bit wrong, you still have some cushion. With Tesco, I had lost sight of that margin of safety as the business deteriorated. So what should you take away from this? Don't fall in love with a stock. Fall in love with the business. And if the business changes, or if your understanding of it proves flawed, be prepared to adjust. A shareholder once asked me at our annual meeting, what's the best time to sell? And my answer usually boils down to this: when the business fundamentals deteriorate, when you find a significantly better opportunity, or when the stock becomes wildly overvalued relative to its intrinsic worth. But the first one, a deteriorating business, is often the most painful and the hardest to act on. This applies to life beyond investing too. It's about being adaptable and open to new information and not letting past decisions blind you to present realities. My partnership with Bill Gates on philanthropy, for instance, changed my thinking about giving. I always planned to give away my fortune, but Bill and Melinda showed me a more effective way to do it, using their foundation's infrastructure and expertise. It was about adapting, learning from others, and always striving to do things better, even if it means admitting that your initial approach wasn't perfect. After 80 plus years of doing this, here's what I know for certain. Investing doesn't have to be complicated. It's really about applying a few simple common sense principles consistently over a very long period. It's about owning slices of wonderful businesses run by excellent people, letting the miracle of compounding work for you, and maintaining a calm, rational temperament when everyone else is losing their heads. I'm 94 now, and if I could tell young investors one thing, it would be this: start early, learn the fundamentals of business, and develop patience. You don't need to be brilliant. You don't need inside information, and you certainly don't need to predict market movements. What you need is an understanding of how businesses create value, the desire to buy them at a fair price, and the discipline to hold them for a very long time, through thick and thin. Never bet against America. Our free market system, for all its flaws, is the greatest wealth creation machine in history. Focus on American businesses that serve its people and the world. Over the long run, the stock market reflects the growth of the underlying economy, so participate in that growth by owning a piece of it. Finally, remember Ben Graham's most important concept, the margin of safety. Always buy something for significantly less than you think it's worth, That cushion protects you from inevitable mistakes and unforeseen events. And never forget that price is what you pay, value is what you get. Aim for value. Keep it simple, keep learning, and keep your emotions in check. That's the best advice I can give you.